A hedge fund, and hedge funds have been spoken about in the press quite a bit, is not unlike a mutual fund in that money is pooled, the money of many investors is pooled and then managed by, in this case, a hedge fund manager who is an investment professional that takes investment decisions on behalf of the investors and contributors of money to this fund. Where hedge funds differ is, first of all, they don't have a benchmark in the same way. Hedge funds are also referred to as absolute return funds, and on that basis they tend to focus just on making money as opposed to beating a benchmark, for example the S&P 500. Hedge funds can also typically often short sell investments, which means selling an investment that one doesn't own in order to buy it back at a lower price and therefore benefit from a decline in price. So hedge funds can basically make money also when an investment loses value, which mutual funds typically can't do because they tend to be long owners of securities, and if the price falls they tend to lose money, whereas a hedge fund can make money when a security's price declines, and more on that in the book. The other way in which hedge funds differ from mutual funds is that hedge funds tend to employ leverage, or often can employ leverage, or are not restricted from employing leverage, i.e. borrowing money to increase the return. And as we remember from leverage, basically when we borrow money to buy an asset, our returns are magnified greatly because the actual money that we have at stake, our own equity, is a small proportion or a smaller proportion of the overall item. And so let's say that we we'll go back to you can go back to the leverage section to clarify that, or read up on it in the book. But they often use leverage to increase the return, and they aren't restricted from using the leverage. So that means arguably potentially better returns if they're right when they're using leverage, but also more risk when they're using leverage. And the other thing that hedge funds differentiate hedge funds from mutual funds is that they tend to be, because they're less restricted in what they invest in, they can react much more quickly to market events. So let's say a hedge fund that has a loosely defined mandate of investing in global equities can respond much more quickly to events, crises, opportunities than, for example, a mutual fund that's defined and constrained to invest in the US stock market. So that's by definition, a more restricted investment, whereas a global equity hedge fund can be very, very quick. It isn't held back by a benchmark that says they have to have so and so much money in Asia, so and so much, or that the benchmark has so and so much money in Asia, so and so much in Europe, and therefore where they don't deviate too much from it, and therefore can't jump into an opportunistic situation. And lastly, hedge funds tend to be less regulated, and that's often a topic of discussion as well. They tend to be offered to wealthy individuals and more sophisticated professionals who are both thought to be better able to assess the risk and also thought to be somewhat in a better position to afford a loss. Whether they're actually more risky, is a matter of how you define risk, because the market risk could arguably be much less with a hedge fund because they're not just buying investments, they also can benefit from in price decline, so they might have much less market risks. In that sense they're less risky, but they might have much more, say, manager risk, because you don't know what the actual hedge fund manager is going to do, so that it's a slightly different risk, but they're certainly, from a regulatory standpoint, they're considered to be generally more risky investments.